done. That means good day. TalkCast PDX. Find us on the web, talkcastpdx.com. It's Tuesday, November 9th, 2021. Name of the show is The Bogdanich Perspective. I'm your host, Paul Bogdanich, and welcome. This is episode number 35, and the title of today's show is Just Another Brick, as in just another brick in the wall. And what wall is that? And there's a equity strategist at Morgan Stanley. He's their chief equity strategist, and he opines, as is his job. And the Americanization of his name is Kolanovic in Serb. He's Serb, it looks like, possibly Slovenian, but most likely Serb. It's Olivic, like that. But he said equity prices should continue climbing the wall of worry. So I am just another brick in the wall of worry. One of us worry warts out here. And he's probably right, as we'll get to later. The only hard news of any material consequence last week was the employment report. So we're going to look at that. Justin, if you could put up slide number 1, please. So this came out last Friday. The headline numbers were 531,000 jobs created, with the unemployment rate falling from 4.8 to 4.6%. Average weekly hours rose to 34.8 hours a week from 34.7 hours the month prior. Average hourly pay increased to $30.96, up from $30.85. And those were the headline numbers. As is my habit, I went into the details of the report and I pulled out all the categories that either showed increases or decreases in jobs of more than or equal to 10,000 jobs. And there's a list. You know, you can see food and beverage establishments are 119,400 jobs added. Professional and technical services were 45,100 added. Temporary help, 41,100. Ambulatory healthcare, 32,300. Heavy construction, non-residential, 31,000. Manufacturing of motor vehicles and parts, 23,700. Accommodation, hotels, motels, etc., 23,200. Warehousing and storage, 20,200. And then a variety of categories less than 20,000 jobs: education services, other manufacturing, retail, transportation, wholesale trade, management and technical consulting, etc., nursing care services, performing arts, and spectator sports, and motion pictures and sound production. And then the numbers in the red with the parentheses or negative numbers where they lost jobs. And that would be local government education, 43,400, state government, 25,000, and building materials and garden supply stores as we move into winter in the Northern Hemisphere, 10,400. And I characterize it as a pretty solid report. You can take that graph down. But I would characterize it as a pretty solid report. And the thing that makes it a little more solid is the diversification of the jobs created. It's not stellar because the biggest thing, food and beverage establishments adding 119,400 jobs, is 36% of the total of 531,000. That's too large. You know, I mean, those aren't the highest paying wage in the world. So if that number could come down below 30%, and then you have the rest of this diversification, that would be characterized as a good report. But this one is certainly not bad. It's not great. But it's for October. Okay, and in October, we had 531,000 jobs created. September, we had 194,000. August, 235,000. July, 943,000. June, 850,000. And then in March, 816,000 jobs created. And if we do a 3-month average, so the average for March, June, and July is 903,000 jobs a month. And if we do June, July, and August, that's 676. And then if we do July, August, and September, that's 457,000 a month. And then if we do August, September, October, that's 320,000. So if you look at that slope, 903, 676, 457, 320, we're trending towards 200 or 250. You need 200,000 jobs a month to keep up with population growth. When you had anemic growth, 1.8%, 2% under Obama, that, these numbers stagnated around that 200,000 number. Under Biden, it looks like we're going back to the same thing. So we'll see how that goes. That came out on Friday. On Saturday, it was written up in the Wall Street Journal, 20-paragraph article. Only 4 paragraphs this time mentioned the coronavirus. And the wording is very curious. When the employment reports were bad in August and September, and they wanted to blame it on the coronavirus, the language that they used was the Delta variant of the coronavirus, or the coronavirus Delta variant, respectively. This time when they mentioned it, they wanted to say, now that we're recovering from the pandemic or out of the pandemic or this and that, they used the word pandemic. See, they dropped the one, so when they want to blame, I'm not sure how much it had to do with any of the reports, but when they want to blame something, the language that they use in the press is the Delta variant of the coronavirus. And when they want to take credit for something, but still note the recovering jobs market, then they say pandemic. We're still 4.2 million jobs below what we were at the beginning of the pandemic. I'm going to read the creed again. The creed is something I put together that explains the market situation as I see it. I'll talk about it after I read it. This is my creed. Looking at what's left of the bond market, lying in what's left of Wall Street, and wanting to earn more than 2% on our savings, we are functionally compelled to participate in the stock market. There simply is no other risk-free or low-risk alternative that pays more than 2%. Through our own fault, by assenting to the government spending as it was happening, as evidenced by our re-electing the same congresspersons year after year, decade after decade, we have contributed to the situation where interest rates can't substantially rise above 2%. This has resulted in the loss of our low-risk investment alternative that we used to call the bond market. Artificially low interest rates also destroyed the former correlation that used to exist between stock prices and interest rates. This disconnects the value of a share of stock from any calculable underlying value, and the share of stock becomes worth whatever someone else is willing to pay. More buyers than sellers make stock prices go up, and more sellers than buyers make stock prices go down. We further acknowledge that the Federal Reserve has been acting as a buyer of last resort. This causes asset inflation, but prevents the stock market from suddenly correcting to some unreasonably low level. Whether we like it or not, agree with it or not, or are willing to admit it or not, if we want greater than a 2% return, we are functionally compelled to participate in the stock market and are therefore reliant on the Federal Reserve guarantee. Each statement that I make in there that's a conclusionary statement. Interest rates can't go above 2%. We're relying on the Fed guarantee. The correlation that used to exist, what is the correlation that used to exist in between bond prices and stock prices and so on. I went into detail in the first 8 episodes. They were audio only. They're available at talkcastpdx.com. I spent at least one episode on each telling you how we got there and why that is. But just the 2%. In between when George Bush became president, George H.W. Bush, George II, became president in 2000. So in between 2000 and 2016, the national debt quadrupled, and the debt to GDP ratio soared. Depending on how you count, debt to the public or total debt, it went up to roughly 100%. Or 78%, depending on which measure you use. But in other words, they bankrupted us with the foreign wars spreading peace and democracy and the bank bailouts under Obama. And if they were to try and raise interest rates to some level where it would be competitive to take your money out of stocks and put it in bonds because you're worried about the price of the stock market, which is what used to happen, it would bankrupt the federal government's on interest payments. So that's not going to happen. We're stuck at 2.5%, 3% at the most, and even that would be temporary. Can't afford it, because we ran the debt too high. The other conclusionary statement, like I say, in the old markets, the bonds used to pay 5, 6, 7, 8%. Okay. And if you thought that, a stock that you bought and it's up 20%, and if you thought it was, just up there on speculation, and you thought that it had a probability of falling 15%, what you used to do is sell it and go buy the bonds, and so money used to flow in between the bond market and the stock market. And this had this mechanism used to keep stocks bounded on the upper end by, small irrelevant things like revenue, revenue growth, earnings, things of that nature, gross margin, cash flow. But now all that's gone. It's a popularity contest because we destroyed the bond markets because of the interest rates. The Federal Reserve guarantee came after the financial crisis. It was unintentional. It grew like topsy. It was not planned. After the financial crisis, by 2010 and 2011, a vast majority, some estimates are as high as 80%, of all the money that was in the stock market at that time was essentially retail retirement funds. Your 401k, your SEP IRA, all that kind of thing, Vanguard, Fidelity, T. Rowe Price, in other words, the people that are investing this retirement money, state employee systems of Colorado, Florida, Ohio, whatever, all your state employees, your union pension funds, your insurance pension, your insurance assets, and things that were tied. And the stock market was very weak because the economy was very weak because Obama was only doing 2% growth. And so the Fed took the tack that because it's all retirement money, that they were going to provide this is under Ben Bernanke, by the way, and that they were going to informally make sure that it had some kind of a reasonable rate of return. And they settled on about 8 or 9%, but it was informal. And in my view, Bernanke would have stopped it at some point, but he didn't stay there that long. And then they appointed Yellen, who is now the Treasury Secretary, and she was all for it. Oh, good, yeah, let's guarantee the stock market. But once she became in and everybody knew that she was going to guarantee it, it became a giveaway program to basically the upper middle class and people higher than that. And it has the characteristic that the more money you have, the more they give you. If you don't have any money in the stock market, then you get shit. Excuse my language. You get jack, right? But, the more money you have in the stock market, the more this largesse benefits you. And it went on and on and on. And, the wealth division, you read about all the symptoms of the disease in the papers, wealth gap, extreme poverty, extreme wealth, anyway, but that's all a function of this guarantee. And this is the hard part. That's kind of the macro situations. The politicians only became aware of that this year. That's all right. This is, as hard as that is to believe, that's the honest to God truth. You had a few of them that knew, but I mean, it only became common knowledge that is the framework of the system when Powell was defending his reelection. And speaking of which, there's an article in today's paper where an existing Fed governor is resigning by the end of the year. Doesn't seem like much, but he's a Republican governor. It's part of the negotiation to renominate Jerome Powell because some of the senators were complaining that if Powell is renominated, it leaves too many Republicans, our team guy, they're like a high school football team up there, the senators. And so that was one of the objections. So they got this guy to resign. Powell will most likely be renominated. He's more conservative than the other person under consideration. This is all according to the press. I don't know, of course. But that was that's the basic framework of the situation we're in. If you could put up graph number 2, please. So you have an implicit Fed guarantee that started in January 2011, roughly. And this chart that we're looking at is just the stock market as measured by the S&P 500 from January 2nd, 2018, all the way through the end of this year, so 4 years. This is when Yellen, mostly, she was the Fed governor from I think she was, I can't remember. But anyway, as you can see, the pandemic drop is that big drop near the middle of the graph. Okay. Look at the area before. I mean, the market, kind of trends up, but then it falls, and then it kind of trends up, and it was positioned for a fall anyway, but then the pandemic happened and it really fell. But, it used to go up, down, and they used to keep a 3-year rate of return around 8% to keep the pension funds solvent. But the pandemic happened, and we had no economy after the pandemic, and they knew it. And so they had to pick some area of the economy to stimulate. And what they decided to do was to inflate real estate prices and stock market values. And so they put the market in a channel that was running up at 30% a year. And if you look at it, it's very clear what they did. Look at it. Look at the chart. They put it in that channel that ran up at 30% a year, and it was going up at 30% a year, staying strictly in the channel for at least the last year. And then look at the very tail end of the graph, the right end over there. You can see where it broke the channel down, and then it's recovered. But that's this current market softness that we've had since September 2nd. That's what it looks like in some kind of a macro sense, a 4-year sense. Markets fell a little bit, broke the 100-day moving average down, and then recovered. And that's in a broader context, that's what the recent softness looks like. Justin, if you could take down number 2 and put up number 3, please. What we're going to do now is zero in just on the last bunch of months. This is just the same graph, except for this is only the portion from March 31st, 2021 through November 1st, which was yesterday, or November. Oh, I forgot to change the date at the top. It's November 8th, and I forgot to change the date in the bullet point. What a dope. Anyway, these are as of November 8th. These are yesterday. But, as you can see, that's what the fall from the previous all-time high, we'll call it, on September 2nd, down to the low on October 4th, and then the recovery as of yesterday. I would point out that the recovery off the support line, if you look at it there, from the last time it touched that support line, that's 11 trading days. And in the very tail of that, where once it got into the channel again, that's where it becomes 11 trading days, is where it first recovers the channel. And out of those 11 trading days, we've made 10 new all-time highs, right, from October 25th to November 8th, which was yesterday. Markets are down about 20 points today, so it doesn't look like today will be an all-time high. But that's 10 out of 11 all-time highs for those trading days. The only day that was not an all-time high was Wednesday, October 27th. And where the markets closed yesterday, they were, what were they? 9.3% above the low set on October 4th and 3.6% above the previous cyclical market high set on September 2nd. It's pretty good move. You can take that one down. The thinking, since, you couldn't count on your manufacturing, we weren't in a position to start another war, which helps manufacturing, defense aircraft and so on, steel, everything like that. That the only part of the economy that they could use to stimulate the market in a pandemic environment was to unjustly enrich some portion of middle-class folk, clearly upper middle-class folk, and everybody above them, using the market and real estate mechanisms. And it's terribly inequitous. like I say, the more you have, the more they give you, or the more you have to begin with, the more they give you. And they only became, that's this big push to tax billionaires. They finally figured it out, right? They finally figured out that through monetary policy and their deficit spending, that's what they were doing. But there is finally some broad recognition of what's happening in the Senate. The strategy worked. Just look. The effects to these companies, if you're some guy with more money than you know what to do with, because what used to be $1 million in your retirement savings is now $1,400,000. What do you do? I mean, you get your groceries delivered to your door. That's like New York in the 1970s, but in those days they used to do it because it wasn't safe to walk home with your groceries. Now we do it, for convenience and other things. They buy a lot of trinkets. Amazon in their distribution business does really well. Delivery drivers everywhere, Uber, look at the changes, in the economy. But it worked. It's the only part of the economy that's working like it should. That's what they've been relying on since March of 2020. That's what they'll continue to rely on. What did our analyst say? Climbing the wall of worry. He expects equity prices to continue climbing the wall of worry. I agree, because it's the only part of the economy that's working. We do have to lay some taxes on the upper class, whether we will or not. Is these guys are so corrupt. We probably won't, or they'll certainly be insufficient. But if we're going to continue with that strategy, we have to do something, or we don't. But then the system will fail. The only things that could possibly, they would have to be forced to drop this strategy now that the senators know about it. Everybody's on board. They're going to renominate Powell, everything like that. Even your strategic analysts at Morgan Stanley, equity prices should continue to climb the wall of worry. Goldman Sachs uses the market. Equity prices will continue to melt up, etc. The only argument against it, and I've been arguing this since 2001, is what's referred to as an epistemological argument. When I was arguing against this policy back in 2011, 2010, 2012, like that, got tired of it. I stopped. Not going to change anybody's mind. But what I used to use to demonstrate what's an epistemological argument, I used to say, think of somebody who you knew personally who's died. Are they still dead? The answer is uniformly 100% yes. And what I'm trying to demonstrate is that there are some things you simply cannot do. That's a very out of favor philosophy or ideology. But if it's true, and there are some things that you simply cannot do, then it'll catch up with you eventually. And, so when you read the press and you hear about bond vigilantes or how the market's going to come down, those are other little bricks in the wall like me who are putting forward these quaint, antiquated theories that don't seem to apply. More rational people were saying that you're building an increasingly tall house of cards with no foundation, and that at some point or another you're going to have problems. But, we haven't yet, and this has been going on since 2012, call it. So who knows? I think they would have to be forced out. Last time they were forced out was in 1974. The Vietnam War ended. Major hit to United States industrial production. Stop making bombs, and then all the other war gear that used to go to Vietnam, which was huge, back in the day, in terms of tonnage and money and everything else. And you also had the oil shocks when OPEC first became a cartel in 1974. And that caused that broke the old system. We had to realign the currency to get it back going. But if you were holding stocks at the high of 1974 in inflation adjusted dollars, in 1979 we also had the runaway inflation like we do now. But for you to get your money back took until 1990 in inflation adjusted dollars, 16 years. From 19, and that's what happened last time. But like I said, the only risk I see to the situation, they have to be forced. Geophysical events, the fault that runs down the west side of Japan, not the east side, the west side. Or excuse me, not the west side, the east side, the ones that runs through Tokyo, would have to throw off a major quake, 8 points or better, or the further element of the same fault that runs right through the middle of Taiwan, 8 points or better. West Coast United States, all the way from the Canadian border, well, actually all the way up through Alaska. But the relevant part is from Seattle to Los Angeles, 8 points or better. So geophysical risk. Geopolitical risk. If that happened, it would be self-inflicted. Taiwan, Ukraine, Syria are the only things that I can see. But it would have to be self-inflicted. Regrettably, I don't have any confidence that we're not that stupid. But, it would have to be self-inflicted. And the other one would be a resurgence of this, the pandemic, shall we say. Let's use the Wall Street Journal language. But in my view, it would have to be accompanied by huge amounts of death. I think that if the pandemic came back and with all these monoclonal antibody therapies and other therapies that they've had time to develop over the last year and a half or whatever it's been, year, call it, and people survived, I don't think that would break the market. If people got sick but then went to the hospital, got these treatments, and then recovered, that would... I don't think that would do it. If it's attended by huge death numbers, I think that would do it. But those are your three risks. Other than those three caveats, I don't see it stopping, certainly till the end of the year. And by that time, we'll have an official renomination of Chairman Powell or not, and some of the other things. So we'll look at it again at that time. And even if it does happen, if you look at this record, the most they appear willing to tolerate is a 5% drop. They they look like they'll tolerate a 5% drop or to the 100 DMA. Markets today, markets on Monday closed at 47.02, I guess, was the close, and the 100 DMA was 44.29. So 44.30 would be the maximum downside before they step in again under this current philosophy. And let's look at our portfolios. Very briefly, I've already been droning on for 30 minutes. But, in that framework, the markets were up another 2% last week. New all-time high every single day, Monday, Tuesday, Wednesday, Thursday, Friday. 92 points, 2% on a $100,000 portfolio. You should have made $2,000. Our portfolios made $2,600, $2,400, $1,439, which was the top three by sector. So the concentration in the gains was in communication services, internet technology, and consumer discretionary, which would be Tesla, principally. And my large liquid leaders, even though I only have less than half the stocks, about a third. I was up $1,000 on a third the number of stocks, but me and my hedges cost me $958, so I made a giant $67 for the week just passed. And if we look at the particular list of stocks out of the 54, my nose is itching today. Excuse me for keep touching it like that. But NVIDIA was up 16.28% last week on no business news at all. It's just popular. Pfizer up 11.1% on that new pill that they have. I'm not going to say anything about it. I don't want to get deleted, but it's temporary. Tesla was up another 9.7%. Elon Musk took a poll on Twitter. This is over the weekend and stuff. Should I sell 10% of Tesla? And the poll on Twitter came back yes. And so Tesla's down big as he starts to sell his 10%. Just publicity stunt. Well, but he's a hell of a promoter. And in a popularity contest, that's who you need as your CEO, is a hell of a promoter. So what are you going to say? Bank America on if Chairman Powell gets renominated, then he'll continue with the lifting of restrictions that were imposed on Bank America particular. So their stock is up 8.42. Nike up 6.11%, mostly on Chinese news, Chinese market. Facebook up 5.5%, basically recovering some of the losses. Broadcom up 5.1%. And then you get down the list. Lynn Corporation, Amazon, Costco, and Comcast were all up more than 4%, but less than 5%. You had 5 stocks that were up more than 3%, but less than 4%, including Intel, Disney, Honeywell. 2 stocks that were up more than 2%, but less than 3%, and that would be Visa and Procter & Gamble. 7 stocks that were up more than 1%, but less than 2%. That's where you have Microsoft and Adobe and so on. 11 stocks that were up, but up less than 1%. And that's where you had Apple and Google and Berkshire Hathaway and the oil companies. And 6 stocks that were down, but down less than 1%, which are mostly your utilities, real estate investment trusts, AT&T, people like that. And then you had 4 stocks that were down more than 1%, but less than 2%. And it's not Boeing Aircraft that was up 8%. It was Boeing Aircraft, or not Bank of America that was up 8%. It was Boeing Aircraft. And I don't know what that's about. Maybe they think that they can finally get a plane in the air. I don't know. And then the stocks that were down below 2%, you have Target, UPS, Thermo Fisher, S&P Global. Those are just 2 that I used to have in my portfolio. PayPal, Abbott Laboratories, and Netflix was the largest loser, 6.5%. Yeah, analysts expressed worry about their subscriber composition, let's put it that way. I'm not sure how valid it is, but when it's a popularity contest, so their temporarily unpopular stock fell 6.5%. 34 minutes. I'm going to go with this. This is just a little bit of in other news, shall we say. In Britain, there's a thing called Oldie Magazine, where they, feature the lives of old people. And they asked the Queen if she would accept to be the Oldie of the Year. And they sent her a formal invitation, And she said, one of her aides wrote back, "Thank you for your letter asking if the Queen would accept the Oldie of the Year award. Her Majesty believes you are only as old as you feel. As such, the Queen does not believe she meets the relevant criteria to be able to accept and hopes you will find a more worthy recipient. This message comes to you with Her Majesty's warmest best wishes," and was sent on a very nice stationery from Balmoral Castle. In 2011, they sent a similar invitation to Prince Philip, the Queen's deceased husband, to be the Oldie of the Year, and he accepted. And in his appreciation letter, he quipped, "There is nothing like it for morale to be reminded that the years are passing ever more quickly and that bits are beginning to drop off the ancient frame." So a little difference in style, I guess. And that's it for me. Been going on for 34 minutes. It's Tuesday. What did I say the date was? November 9th. This has been the Bogdanich Perspective. I was your host, Paul Bogdanich, every Tuesday. Sometimes we're on YouTube, sometimes not, depending on what I'm going to talk about. And what else? Join me next Tuesday, TalkCast PDX. Find us on the web at talkcastpdx.com. And do widzenia. That means goodbye.